We shall now discuss accounts of non-trading organizations. We will try to find out what is the meaning of non-trading organizations, what are the different books of accounts to be kept, and how the final accounts are drawn up in case of non-trading organization accounts, and what is the distinction between receipts and payment account and an income and expenditure account, which are normally maintained by a non-trading organization, and how to convert one from the other, and how to prepare the balance sheet, and what kind of adjustment entries are required to be passed in the case of a non-trading organizations. So let us start with the meaning of the non-trading organizations. So as the name suggests, these are organizations engaged in rendering certain services to the people. That means they are not in the business of trading. Examples are educational institutions like schools, colleges, sports clubs, public hospitals, charitable trusts, etc. So their main purpose is to render service. For rendering services, they collect monies by way of membership fees, tuition fees, subscriptions, donations, etc. So this is the source of income for non-trading organizations, and they are by and large non-profit making entities, but still they need to maintain books of accounts to know whether their income is sufficient to meet the expenses, and in order to have control over the collections made, and also to submit the final accounts to various authorities, including the government authorities. Therefore, even in the case of non-trading organizations, though the profit motive is not there, they are still required to maintain books of accounts. So we have to understand as to how the books of accounts are maintained, what are the different kinds of books maintained by the non-trading organizations, and what kind of entries are required to be put through. So in the case of non-trading organizations, they are required to maintain several books of accounts. They are, one is of course the cash book, then there is general ledger, third is called the journal, fourth is the membership register, fifth is the donation register, and sixth is the property register, and seventh is the subsidiary register. So cash book of course is the main book which they are required to maintain, which will list all the receipts and payments in terms of cash. General ledger is a ledger of the various accounts maintained by the non-trading organization. Journal, in order to put through all entries which do not get reflected in the cash book. Membership register is a register detailing the names of members, their addresses, telephone numbers, etc. And donation register is to record all donations received, the purpose for which they are received, and any directions given by the donor in terms of use of that particular amount. Property register is the register detailing all the properties owned by the non-trading organization, whether they are movable assets or non-movable assets. And subsidiary registers are registers to take care of different aspects of the non-trading organizations. For example, what is the subscription received from the members, how many subscriptions are in arrears, and what kind of activities they undertake. All these are maintained through different subsidiary registers. And as far as the final accounts of a non-trading organization are concerned, they consist of three important statements. One is called the receipts and payment account, second is called the income and expenditure account, third is called the balance sheet. So the only distinction between a non-trading organization and a trading organization is that in the case of a trading organization, in addition to balance sheet, we have got a profit and loss account, whereas in the case of a non-trading organization, in addition to balance sheet, we have got two other accounts. One is called the income and expenditure account, which is almost same as the profit and loss account. Since profit is not the motive for a non-trading organization, it is referred to as the income and expenditure account. In addition to that, they also maintain another account known as the receipts and payment account. So let us understand the meaning of each of these statements and how they are prepared and what are recorded therein. So in the case of receipts and payment account, it shows the actual amounts received and paid in cash. That means anything received and paid in cash is taken in the receipt and payment account, and cash normally means including the checks. That means cash also includes checks in the case of a receipt and payment account, and there is no distinction made between revenue receipts or capital receipts, or revenue expenditure or capital expenditure. Anything received is recorded on the receipt side, anything paid is recorded on the payment side. So it starts with the opening balance of cash and bank on hand and ends with the closing bank of cash on hand. So what is done is opening bank to the opening balance of bank and cash, we add all the receipts received during a particular period. It could be based on a monthly basis or half yearly or even quarterly, but normally it is closed for an accounting period, that is 1 year, and at the end we have a closing balance after taking into account all the expenses paid out through the receipts and payment account. That means the opening balance plus all the receipts is always equal to the expenses paid through the receipt and payment account plus closing balance, that both of them tally. And the second statement, as we know, is the income and expenditure account. It is the same as the profit and loss account. As the objective of the entity, a non-trading organization, is not to make profit, the name has been changed to income and expenditure account instead of calling it as a profit and loss account. Just like a profit and loss account, all income items are shown on the credit side and all expenses are shown on the debit side. The result will be either profit or loss depending on whether the income side is in excess or the expenditure side is in excess, and the profit or loss is called either the surplus or a deficit. If it is a profit, then it is called a surplus. If there is loss, it is called a deficit. Balance sheet again is the same as in the case of a trading organization. It is a statement showing the position of assets and liabilities as at a particular date. It is always for a particular date, whereas the receipts and payment account is for a particular period, normally 1 accounting year. Similarly, income and expenditure account also is for a particular period, normally 1 accounting year. Now, we have to understand the distinction between receipts and payment and income and expenditure account. So, there are a lot of differences between the two. So, we have to understand how they differ from each other. So, in the case of a receipts and payment account, it is a real account, whereas interest and income and expenditure account is a nominal account. Secondly, receipts and payment account contains the summary of actual expenses and receipts of a particular period. Whatever expenses are incurred, whatever income is earned during that particular period actually received is accounted for in the receipts and payment. Whereas income and expenditure account details the income and expenditure of a particular period. That means whatever pertains to that period only is accounted for, whether received or not. Whether received in advance, then it is not accounted for. It is always on an accrual basis. So, in the case of a receipt and payment account, it includes both capital as well as revenue items. There is no distinction between capital receipts and revenue receipts. Whereas, in the case of a income and expenditure account, it includes only revenue items. Capital income is not included in the income and expenditure account. In the case of a receipts and payment account, it always starts with a opening cash and bank balance and always ends with a closing bank and cash balance. Whereas in the case of income and expenditure statement, there is no opening balance, but it ends with a surplus deficit of the year. That means only the surplus or the excess of income or expenditure or the deficit, that is the excess of expenditure or income, is shown. And in the case of the receipt and payment account, it shows all receipts and payments irrespective of whether these pertain to previous year, current year or future years. That means there is no distinction between the payments and receipts, whether or not they belong to the current year or not, they are all included. Whereas income and expenditure takes into account only items of income and expenses which relate to that particular year only. And therefore, because of this distinction between the two, certain items are treated differently in both the accounts. Let us try to find out how they are looked at. One is the donations. If donations are received for a specific purpose, they are credited to the fund account and shown on the liability side of the balance sheet. For example, if somebody donates for a building, it is credited to the building fund. If it is for creating an endowment, then it is credited to the endowment fund, etc. If donations are received without any specific purpose, they are shown on the income side of income and expenditure account. Then only they will be treated as income. Otherwise, they are directly credited to that particular fund account because they are meant for a particular purpose on the wishes of the donor of the amount. In the case of entrance fees, these are fees collected at the time of admission of new members. They are collected only once during the lifetime of the membership of the person. So they are treated as non-recurring in nature. That is, they are treated as capital receipts and only taken to the balance sheet. They will not come in the income and expenditure statement because they are capital receipts. And in the case of life membership fees, it is also treated as a non-recurring receipt and therefore taken directly to the balance sheet. Legacies are also treated as a non-recurring receipt. And in the case of government grants, there are again two types of grants. Grant can be for maintenance, and if it is for maintenance, then it is taken as income. If it is received for a specific purpose, for example, for creating some asset, then it is credited to that particular fund. It could be a building fund or a land fund or some other fund for which purpose the government has given the grant. And there is also a fund called special fund. If any fund is created, all income expenses pertaining to that fund shall be adjusted against the fund. For example, you have already created a fund and some money is spent out of that fund for that purpose, then whatever money is spent is debited to that fund account only. It will not go to the common expenses account because that expenditure is incurred for the specific purpose for which that fund has been created. And in the case of opening and closing stock of stationery, these will appear in the opening and closing balance sheet respectively, and the stationery consumed during there will appear as an item of expense in income and expenditure account. That means stationery also is shown separately. Only whatever is consumed is treated as expenditure, whereas the closing balance will appear as an asset on the balance sheet of the non-trading organization. In the case of sale of fixed assets and investments, such receipts are treated as capital receipts. Profit or loss on sale of fixed assets investment is shown in the income and expenditure account. That means any money received on account of sale of fixed assets and investment will not be taken to the income and expenditure account. Only that portion which is a profit or loss on the fixed asset account is taken to the income and expenditure account. Similarly, in the case of purchase and sale of sports material, it is treated as a capital expenditure and then shown on the asset side of the balance sheet. Depreciation charge is reduced from the asset and shown as an expense, like we do in the case of a trading organization. And now let us try to understand as to how to convert a receipt and payment account into an income and expenditure account, and what are the essential differences between the receipt side of a receipt and payment account and the income side of a income and expenditure account, and similarly what is the difference between a payment side of the receipt and payment account and the expenditure side of the income and expenditure account. In the case of the receipt side, when you want to prepare a receipt and payment account, start always with the opening cash and bank balance that is taken directly from the balance sheet. That is, the closing bank and cash balance of the previous year's balance sheet becomes the opening cash and bank balance of the current year. Then all revenue receipts to be shown on income side of income and expenditure account. So you have to take all revenue receipts to be shown on the income side of income and expenditure account. Whatever revenue receipts are there which are reflected on the receipt side, only those will go to the income and expenditure account to the income side. That means if there are capital receipts, though they are shown on the receipt side, they will not go to the income and expenditure account, because income and expenditure account only revenue receipts need to be taken into account, and that too receipts only for the current year need to be taken. That means if the receipt include any receipts on account of the previous year or on account of the future year, they need to be adjusted for. So therefore adjustments need to be made in order to ensure that all receipts pertaining to the previous year or future years are taken out. Only whatever pertains to the current year will go to the income side of the income and expenditure account. And similarly, donations which are received for specific purposes are taken directly to the balance sheet. They will not be taken to the income and expenditure account. And in the case of sale of fixed assets, reduce the book value of the asset in the balance sheet. Any profit or loss only is taken to the income and expenditure account. Receipt side takes all receipts in the receipt side, whereas in the case of income and expenditure account, you take only the profit or loss. If there is a profit, you take it to the income side of the income and expenditure account. If there is a loss, you take it to the expenditure side of the income and expenditure account. Similarly, from the payment side also, we have to take certain items to the income and expenditure account. So, in this case, all revenue payments for the current year only will appear on the expenditure side of the income and expenditure account. That means, payments may consist of both revenue payments as well as capital payments. So, you have to pick up only revenue payments to be taken to the expenditure side of the income and expenditure account, and even there you have to take only those revenue payments which relate to the current year. That means, any revenue payments relating to the previous year or to the future years have to be adjusted for. So, you have to pass the adjusting entries, and only current year payments will go to the income and expenditure accounts, and whatever relates to the previous year or to the subsequent years will directly be shown in the balance sheet. And similarly, capital payments, any appearing on the payment side, will not be taken to the income and expenditure account. They will directly go to the asset side of the balance sheet. And similarly, closing cash and bank balance will appear on the asset side of the closing balance sheet. So, this will be directly taken to the balance sheet. It will not go to the income and expenditure account. That is how we have to convert a receipts and payment account into an income and expenditure account. To recapitulate, what we have to do is, we have to remember two things. One is, whatever revenue receipts and expenses are there only are taken to the income and expenditure account. Second, even those revenue receipts and payments which relate only to that current account year are taken to the income and expenditure account. That means, anything pertaining to the previous years or the future years are adjusted, are removed from the receipts and payments, and the rest only will go to the income and expenditure account. Whatever adjustments you have made, they will go directly to the balance sheet. Similarly, capital payments and capital receipts will directly go to the balance sheet, and the closing cash balance will go to the asset side of the balance sheet. It will not go to the income and expenditure account. Now, we will talk of some of the adjustments which are needed to be made in the books of the non-trading organization. So, they are in terms of outstanding income, in terms of outstanding expenses, income received in advance, similarly prepaid expense and depreciation assets. In the case of outstanding income, it should be included in the respective income account shown in the closing balance sheet on the asset side as income receivable. So, what is the meaning of this? If some income pertaining to the current year has not been received, it is not taken in the receipt side of the receipt and payment account, but it is to be taken on the income and expenditure account as income to be received, because income and expenditure account is always on the basis of accrual. That means, whatever income relates to that particular year, whether received or not, has to be accounted for, and since this is an asset of the entity, it will also appear in the balance sheet on the asset side. Similarly, outstanding expenses, though have not been actually incurred, they relate to the current year. So, they need to be taken to the expenditure side of the income and expenditure account, and since they are a liability to be met in the next year, they will appear as an item in the liability side of the balance sheet of the entity. Similarly, income received in advance is what it does not relate to the current year. So, it has to be removed from the income item. That means, it cannot be shown in the income and expenditure item, and since it is an item received in advance, it will be shown on the liability side of the balance sheet. That means, it does not pertain, it is owing by the entity to somebody else who has paid that advance. Similarly, prepaid expenses, which is just the opposite of outstanding expenses. These are expenses which have already been met, but do not relate to the current year. So, they have to be removed again from the income and expenditure account, but have to be shown on the asset side of the balance sheet as prepaid expenses. So, prepaid expenses appear on the asset side, whereas income received in advance appears on the liability side. As against that, outstanding income appears on the asset side, whereas outstanding expenses appear on the liability side of the balance sheet. And the last one is the depreciation on assets. It has to be reduced from the respective assets and shown as an expenditure in the income and expenditure account. So, depreciation does not become part of the receipts and payment account, because there is no receipt or payment of cash as far as depreciation is concerned, but income and expenditure has to take into account depreciation on the assets. Therefore, it will go on the debit side of the income and expenditure account, and ultimately in the balance sheet the assets will be shown at a lesser value, that is the original value of the assets minus the depreciation provided for.